All right, we're going to go ahead and get started. Thank you so much for showing up for our second webinar, Financial Literacy for Digital Marketing Firms, by our good friend Jody Grunden. Jody Grunden, I can say it. I'm excited because I didn't break the link this time. For those of you who are at the first webinar and had to get an emergency link at the last second, feeling pretty chipper with myself right now that we actually got through it this time. We also had a few hiccups with the platform itself. We think we've learned a few tips and tricks. So definitely let us know if you're having any issues whatsoever in terms of the slides themselves or the audio quality or anything like that. So we really appreciate it. And without further ado, I'm going to turn it over to my good friend, Jody Grunden, who is part of the leadership team at Summit CPA Group. And today he is here to talk to us about financial literacy for digital marketing firms. Take it away, Jody.
Thanks, Carl. I appreciate that. First of all, I'd like to thank you for giving me the opportunity to reach out to so many of you guys with the topic that's so really near to my heart, and that is the financial literacy. And if you've seen me in any of the other events, you've noticed I've talked a lot about metrics and how that all kind of gels into the world of the digital marketing world. And we're going to make kind of a twist of that today and kind of get a little bit more in detail about how to set up the structure itself before we actually would be able to dig into those metrics. The presentation, we're going to make it available afterwards for download. Carl will take care of all that when we're all done with it. So I just want to give you guys a heads up on that. The deck will be available for you. Starting off with a quote, love quotes. This one is one that's really near to me. Prediction is difficult, especially when dealing with the future. It truly is, but if we plan for the future, we've got a better shot at it. And so that's kind of what I'm trying to illustrate today, talking about these 4 different areas of the financial literacy. The first I'm going to talk about is a chart of accounts. Then I'm going to go into cash versus accrual to kind of give you an idea of what you should be reporting your financials on, and then kind of talk a little about financial statement metrics is the third one, and then the fourth one will be talking about really how much money should you keep in the bank for your firm based on your firm's size, needs, and wants. Starting off with the chart of accounts. The importance of this chart of accounts, it's really the basic of your financial statement. And so what we want to do is we want to show you what we feel a chart of accounts should look like. And that would deal with both the balance sheet and the income statement. And then we want to do this so that you can compare from one company to the next. We have several companies in the digital marketing field. And by keeping the chart of account consistent from one company to the next, we can really compare. And the funny thing is that all the digital marketing companies have many different ways that they're organized, whether they're a sole proprietor, a partnership, an LLC, a C Corp, S Corp. It really makes no difference regarding this chart of accounts. So we're setting this up so we can compare across all lines of entities as well as the difference in the different marketing fields. So I'd like to start off with just kind of showing you what we look at as what we call a balance sheet. With the balance sheet, you'll notice that the balance sheet in this example is just a sample example. We go from January through December. This is kind of looking forward, a forecasted balance sheet. And with that, we have 3 different levels. We have the assets, the liabilities, and the equity. With that, starting off, if you notice total cash, we want to have what we call an operating cash account and a cash reserve account, and those should sum to our total cash. So when you're setting up your chart of accounts, make sure that you have both. And what the difference is, the operating cash account is just simply the cash that money's coming in and out on a daily basis, probably what everybody has. A cash reserve account is once you've met what we call a minimum amount needed in your operating account, you want to move the rest of that money to what we call the cash reserve account. And that cash reserve account should be like a money market account, something like that, that can earn a little interest so that your money is just not sitting there and not earning anything for itself. And we'll talk a little bit about that later. The third account we want to set up is the tax reserve account. And that account is specifically designed and set up for taxes. So each month, each week, whatever time frame or interval that you like to put, we move money to this account on a regular basis, and then when we make our estimated payments, we pull that money out of this account. The importance of it being outside the traditional operating cash is so that you don't use it for operations. You don't misuse it, and then at the end of the year, comes time to the tax time, Uncle Sam, and you don't have the money to pay for them. So what we like to do is we like to keep it kind of out of sight, out of mind, keep it completely outside of the operating cash. And then, of course, you have the traditional things, accounts receivable. Your current assets is the combination of all of those. We have current liabilities, which would be your accounts payable, line of credit, that sort of thing, things that you're going to pay within the next year. Other liabilities would be long-term notes. Most of you folks don't have those, but if we do, we'd put those in other liabilities. And then, of course, you've got the equity. Equity would be the partner's equity for a partnership or an LLC. It would be stock, common stock, paid in capital and so forth for a corporation. Distributions, I like to keep that on a separate line, and I like to close that out at the end of the year so you can see exactly what you're distributing to the owners, and so that the you can really get a good pulse on it. And we take our tax distributions, we run them through that account. Now, kind of going one step further to the income statement, we have what I call 5 different areas we want to keep track of on the income statement. The first is the revenue account right above the blue line there. The revenue account, it should just be simply 1 line, maybe 2 lines, maybe 3 lines. Don't make it very complex. Keep it as simple as possible. If you would like to break it out by product line or by service type or something like that, a lot of times you'll have different software such as QuickBooks or Xero or FreshBooks or whatever it might be. You can break those out into classes and run your reports by classes. We recommend that as opposed to creating a separate line on your chart of accounts for each one of those different items. So revenue would be just simply 1 line, maybe 2 lines. Production expenses would be another class. You got your administrative expenses would be another class. Gross profit, well, between revenue and production expenses is what you call your gross profit. And let me back up one more step there. It's important in your production expenses. That's kind of like a manufacturing company. They have the cost of making a product is what the cost of goods sold. For a service company, we call that cost of sales. So the production expenses are your cost of sales. So that'd be your production people. And I'll break that out here for you in detail in just a second. Gross profit's the difference between your production expenses, pulled out of your revenue, just one minus the other. Administrative expenses are going to be everything that's administrative to the company, dues, memberships, all that kind of stuff. And we'll break that out here in a second for you. And then marketing expenses, and then wrapping up with facility expenses, and then net income. So those are going to be your basic groups, I'm going to say, that you would actually set up your chart of accounts in. And I would set them up in a way that you could actually collapse it at any point in your financial statements and actually see everything broken out in these 5 groups. It makes things really simple, and you can really kind of compare again from one period to the next. Now let's break it out in a little detail here. If we look at our production expenses themselves, in the production category, so if we were to go as a subclass of that production category, we're going to break it out into a few different areas. The first area we're going to break it out is what we call our production employee expenses, as you can see in the bolded area. Under that area, we're going to include everything that you've seen here. We're going to include production payroll. Again, that would be your producers. The taxes that are associated with those. I don't really see the need to breaking out many different tax categories. Keep them all crunched into one if you can. Make it really simple to read and understand. Again, you want to make this simple for everything. Production benefits, and then make subclasses for those. And again, don't get into too much detail about it. The important things are the health insurance, the 401k match. You may have life insurance. You may have some basic things that you want to break out. And you're breaking everything out so that you can actually track it going forward. And so make it so that it's collapsible. So you can see, again, payroll expense, payroll tax, production expense, your 401k, as I mentioned before. And then we call production education. Now, with some of the folks out there are distributed, some are not. We're a distributed company, so we know exactly how that all works. With production expenses and production technology, what those are stipends that we give our team, our employees, so that they can educate themselves. They can go to different seminars, that sort of thing, and we set aside costs for those. So if the education or the CE or the CPE or whatever you want to call it is related to the actual producer, then they belong in this category right here, the production expense category for the production education. And then the same thing goes along with the production technology. Many times we're going to see that a distributed company will give $2,000 a year, $2,500 a year to maintain their equipment, so the team can maintain their equipment. And the same thing really goes to the brick and mortar company. They're going to spend, to upgrade equipment and all that kind of good stuff related specifically to individuals. Now, this has been an expense line that really opened things up just a little bit ago. Last year, when the IRS came back and said that we're going to change the de minimis rule from $500 to $2,500, it made this expense really cool, because now we can track everything within this expense as opposed to having it run through depreciation, which is nice, unless it's over $2,500, of course. But yeah, again, not too many things are going to fall above that limit for the folks out here in the digital marketing world here. So with the production technology, running everything through that's related to that producer again. Don't think I would split things out. Just keeping it into that technology is pretty cool, and it works pretty well. Then outside of the employee expense and the production, you're going to have other types of production expenses you're going to want to break out. Software expense, anything that's related to the production of the actual end product. And so we kind of break those out right there so you can kind of see the difference. Now, kind of getting back to the administrative, so production's pretty simple, revenue's pretty simple, production gross profit is just one minus the other. So now looking at the administrative expenses, again, relatively the same thing. And with that, we're going to have your administrative expenses such as your administrative payroll, payroll taxes, the admin benefits, the health insurance, identical to how we set it up in the production, software, and then what we call other expenses. And with those other expenses, here's some common expenses that we find out, or we see from firm to firm, bank fees, credit card fees, dues and subscriptions, insurance other than health insurance would be in this other category, internet expenses, legal fees, payroll processing, and so forth. You can kind of list them there, and you can have really as many or as little as you want. And it's kind of a rule of thumb. If you don't use the account more than 3 times in a year, look for a different account to place it in. Don't create an account just to create an account. Generally, don't create accounts with vendors' names on it, with bank names on it, anything like that. Keep them pretty generic. In this case, taxes and licenses is not going to be the New York City taxes. It's going to be taxes and license. Then you'll slide New York City taxes inside of it. That type of thing. With that, again, as many or as little as you want. My thing is to keep everything simple. Marketing expenses. We're looking at relatively the same thing with marketing expenses as we did, with the others. You're just simply you're breaking the payroll out for the marketing, payroll tax, marketing benefits. You could have advertising as part of that. You could have, software expense, again, any other marketing expense. And again, it's up to you. But I would keep it in the same structure with the employees first, and then everything else falling below in alphabetical order. And then we have facility. Facility, obviously, we don't have people in facility. So you just have your basic, stuff like rent, cleaning and maintenance, repairs, utilities. And I broke it out: utilities, gas, electric, water. You don't have to if you don't want to. If you think, hey, I'm good with just utilities, I'm not going to really monitor my gas, my electric, or water, don't create a separate account for it. If you think you want to monitor it and make a change if something doesn't look right, create a separate account. So I left that as an example here of what you may or may not want to do with the utility expenses. And then the question is, where does owner's compensation fit in all of this stuff? Well, for the chart of accounts itself, you really truly do need a separate account. But when we go through the percentages after in the financial statements, I'll show you how to break out the owner's compensation within those financial statements. For instance, in this case, we generally will slide owner's compensation, other income, and expenses. And we like to do it that way because, again, that makes all companies, again, on the same playing field. Whether you're a sole proprietor, where you don't really have an owner's compensation because you don't really pay yourself, you pay yourself a distribution. A partnership, similar type of manner, where you really don't have a payroll expense. Again, you're paying yourself a distribution. Or an S Corp or a C Corp or an LLC, depending upon how you're set up, may have a salary that you're required to take. And so we run that after we hit the net income, so we can kind of, again, keep everybody on equal playing field there. And so that would be other income and expenses. And then if you look at your net income after that, then you're looking at net income after owner's compensation. So again, the idea behind all of that is to make sure that you've got everything set up so that you can actually break everything down, compare administrative, marketing, facility, all the different major areas of your financial statement in a really simple, financial statement look. So it's not really confusing. It's really simple, and then you can compare from one company to the next. So if you need to look at industry data and compare how am I doing in the industry, it's real simple to compare. There's not really a whole lot of work you have to do on your side. And as I mentioned, some of the things that you'd want to put in the owner's compensation wouldn't be just simply the salary itself or the guaranteed payments if you're an LLC or partnership, but you also want to put your payroll taxes, benefits such as health, disability, life. These are important to break out for the tax return. That's why they're really essential to break out separately from everybody else. And then just bundle that up. What I would not keep in this area, I don't think it's important to know, the owner's technology expenses. I'd put that in either administrative or marketing, depending upon which of those areas the owner focuses most of their attention on. Education would be the same thing. This would just simply be compensation. Now, if you're throwing some fluffy stuff in there, which hopefully you're not, but if you are, then slide that here too, so that you're not distorting your financial statements. So again, they are comparative. So that's how we set the chart of accounts up. So again, a really basic thing. One question you might have is, do I number the chart of accounts? We do, and it makes it really simple to track between marketing and admin and so forth, because we're going to have the same labels for our payroll, so it makes it simple if we make, 1 to 3,000, 1 to 4,000 series, 1 to 5,000, or 3,500, 4,500. The numbering system really doesn't make any difference. It's really up to you on how you put that together, but, numbering is something that you could attach to that chart of accounts if you'd like to. Now, the next area I'd like to talk about is cash versus accrual versus tax. It's really important that you understand the difference between the three and which one you actually should be reporting on the financial statement. But before I actually go through and tell you which one that you should be reporting things on, I'm going to explain the difference real quick to you. What is a cash basis financial statement? Well, the way that cash basis financial statements work is that revenue and expenses are recognized when cash is received and expenses are paid. So you get a deposit from a customer that you worked on, 2 months ago. It gets deposited in the bank. It gets recognized when it gets deposited. An expense that you may have been putting off forever, and you finally paid it today. Well, it gets expensed not when you earned it, but when you actually paid it. So again, it's when actually cash is paid and or received, depending upon how it's being recognized. Accrual basis is an accounting term used to recognize revenue and expenses when it's earned and incurred. So the difference there is, if you're working on a project in the entire month of April, from April 1st all the way to April 30th, and you bill the project on May 1st, when do I recognize that revenue? Well, you recognize the revenue in the month that you incurred the expense. So you actually earn the revenue. So from April to April 30th, April 1st to April 30th, you're going to recognize the revenue in the month of April. So you have to make sure you journal entry that and recognize it in the correct month. And the same thing goes with the time earned. So you could be paying your team on let's say on a biweekly basis, and the way it falls, they may have worked on that project in April, but they got their paycheck for that money in May. So how do you recognize that? Again, you journal entry and you recognize it in the period that earns, because what you want to do is you want to match your revenue and your expenses so that you know exactly how profitable you are in that month, not because of a timing issue, but because that's what you earn. And that's really going to help you when you recognize, when you actually calculate your KPIs, because if you don't do it correctly, then you're going to be relying on false information. So accrual basis is extremely important to understand. And then the third one, and there's several different bases, but the third one's tax basis. And this is what you pay Uncle Sam on. So a lot of times people will say, yeah, I pay my taxes on cash basis. That's why I need to report. That's why I need my financial statements look that way. the tax return has nothing to do with your financial statements. With your financial statements, you want to report them so that, again, when the recognized revenue and expenses are earned, tax basis is just all the different adjustments that you're going to make, and that can be presented both cash or accrual. Most people present it in a cash basis, but it could be both, and then it's adjusted for tax items. You know, one of the biggest tax items that you're going to find is probably meals and entertainment, in which, you know, that you actually truly had $100 for that meal, but for tax purposes, you only get to recognize $50. And so people can do a combination of all the different things. The one I'm going to say is accrual basis is the key, and I want to show you the difference on what actually happens if you're reporting things wrong on a cash basis versus accrual versus tax. In this example right here, I made it a really simple example where a person earned $4,000, received $1,500, paid out $1,500 in rent, paid out $100 in meals, paid out $250 in utilities, and actually had advertising expenses that they incurred but didn't pay out until the following month, and kind of show you the difference in how it all impacts. As you can kind of see, in an accrual-based accounting, you report the $4,000. That's when it was earned. In a cash-based accounting, you're reporting the $1,500. That's when that was actually received. A tax-based accounting, again, you can go either or. In this case, I picked cash for this example. And with that, again, I'm going to do what was received. And as you can kind of see down with the advertising there, cash base is 0, tax base is 0. Meals, cash base is 100, tax base is 50. So kind of going through, not paid does not get recognized on a cash basis or a tax basis in this case. And so if you look at the difference here, and I'm looking at an accrual versus cash, you can kind of see a $1,900 difference between the two of net income. So you could be saying, you know what, I'm doing really great this quarter. I'm reporting things on a cash basis, and then you're talking to the person next to you, and they're saying, yeah, we're having a really crappy quarter, and we're reporting on an accrual basis, completely different information that you're sharing there. And so that's why it's important for everybody to be on an accrual basis so you know exactly how your quarters actually truly went. A pretty basic concept. With financial statements themselves, we're going to talk a little bit about what you should expect as the different metrics in your financial statements and really how they compare to the industry itself. And I just threw an example up here for you, kind of covering the number of production employees. I've got 1 through 50 there to kind of give you an example where you might fall within that example there. The far right corner is the most important thing, and that's the percentage of income. So whatever you're at, you can kind of look and see what percentage of income you are and kind of see where you kind of fall within that range. So looking at revenue, looking at employee costs, where we find that employee costs, an average of about $75,000 for a production employee. And again, extrapolating that over, from 1 to 50, you can kind of see where it falls. Now, as we all know, employees cost more than just the salary that they have. And we find that the burden rate of an employee is going to generally be about 24%, maybe 28%, depending upon the culture of the company. If you're the type of company that gives a lot of different benefits to your team, and those would be hard benefits like health insurance, 401k match, life insurance, disability, all those different things, really go into this calculation of the 401k. So that's going to vary dramatically from company to company, but we find on the average that 24% generally, falls between most of you folks. Employee costs then would be about 46.5% of the overall revenue. And again, that's only production people, not admin, not marketing, not owners, unless owners are truly production people as well. Other production costs we find to be about 44%. That would be the other stuff that we mentioned in production, which gives us a gross profit of approximately 50%. We find that the gross profit varies very small between companies from East Coast to West Coast to in the middle of the United States. The difference is not very big at all. And with that, we find that on the high end, companies will have gross profit around 40, or probably 51% gross profit, maybe 52 if they're lucky. On the low end, 48%. So over time, it fluctuates from month to month, but over a 12-month period of time, you're looking right at about a 50% gross profit. And then we look at what we call overhead costs. And the overhead costs I'm going to look at or kind of address real quick would be your administrative overhead costs and your sales and marketing overhead costs. Again, both of these include payroll, as we mentioned before in the chart of accounts. The combination of the two is really what's important here, and that's 30%. So we find that overhead costs generally will be about 30%. Administrative expenses is kind of the plug number in this group here. Sales and marketing is a big thing. Sales and marketing varies between 8% and 11%. We find that 9% is a very common number. We've seen as high as 11% being sales and marketing. And this would be for a service-based company. So a service-based marketing company, this would not be for products. If you're a product-based company, well, then your sales and marketing is closer to 15%. So it's a little higher for a product-based company because you're spending more time and other types of resources on that number. So sales and marketing, we're finding about 9%. The total of the two is the important thing. Then we have what we call facility costs, and we talked about that, rent, utilities, that sort of thing, and that's about 4.5%. Now, the question is that, if you're a distributed team, what does that mean? That means, well, I just saved myself 4.5%. Well, not really. 4.5% generally covers the time that distributed folks meet up throughout the year. Generally, they have an annual meetup where they'll meet up and bring everybody into a central location. We find that they spend about $2,000 a person in order to make that happen. With that, one time a year, and then the second time a year, usually it's a departmental meetup where they might be meeting up as a department various ways throughout the year, and that comes to about 4.5% total. So what we find the savings that a distributed company you would think would have over a brick and mortar company, they really don't. It's about the same. So when you look at the total overhead picture, you're really truly looking at 34.5%, and it's broken out between the sales, marketing, admin, and so forth. Now the question comes, really, where do the owners fit into this bucket? Because the owners are down below that we had in that other income and expense item. Well, here's where you have to do the off balance or off income statement math, and you have to really push the owners into the bucket that they belong into. So if I'm an owner and I'm 50% business development and 50% administrative, well, then I'm going to split my time between, half my salary is going to go into sales and marketing, half is going to go into admin. If I'm an owner that's a production-oriented type owner, or I'm actually producing a lot, well, then I'm going to put part of mine in production and then part of mine wherever else it might fit, sales and marketing or admin. Now, the key there is, and the reason why we put owners at the bottom is because we don't want to distort the numbers, because the owners would say, you know what, I'm playing the tax game and I'm going to take a $30,000 salary and then I'm going to take $120,000 in distributions. Or I live in New York and I'm going to pay myself $250,000 or, whatever. So what we do is we set the owners and say, hey, all owners, no matter how many owners, are going to be $150,000 each. And we're going to move that money and allocate it accordingly throughout the income statement here. The difference we're going to say is just simply profit and goes to the bottom line. So when we look at the bottom line, we want the bottom line to be about 15% after owner's salary. And again, 15% adjusting owner's salary to $150,000, whether we've got to do it or we got to increase it or decrease it to that $150,000 mark, the bottom line's that. Now that's our goal. In order for a company to exist in the digital marketing world, they've got to have really a minimum of 10% net income. And so 10% is the minimum net income that you need in order to cash flow. And 15% is really where you want to go. That's kind of like your target net income. So then it leads to, well, really, how much money should I have in the bank? Now that I know what my net income needs to be, I know where my expenses are breaking out, what kind of net income do I need? And so here's where we look at that balance sheet that we looked at earlier. And the key to the balance sheet is we're going to be looking at what we call our current assets. That's our operating cash we talked about, the total cash, the tax reserve, and the accounts receivable. I really don't care about anything else other than those. I don't care about notes to the back and forth between owners and employees and all that kind of good stuff. Don't really care about that. I'm looking at strictly the current assets there. And then we compare that to our current liabilities. So current liabilities, again, accounts payable, what you owe people and your line of credit. And if you do happen to have a long-term note, then we want the current portion of that long-term note, which would be, basically 12 payments of that note would go in the current liability side. And again, Looking at a balance sheet, this is at a point in time, so this is an accumulation. This isn't per month or anything like that. So it just tells me how much money that I have in the account. So in this case, in January, I've got $236,000. In December, I'm looking at having $448,000. So again, that just tells me a point in time. And you can kind of see the tax reserve, 0, 20, 40. So I'm building my tax reserve of 40. Uncle Sam wants his part in April, so it gets reduced down. 20, 40, Uncle Sam wants his part again, and so forth. That's how you read the balance sheet there. So now, what are the important metrics to the balance sheet? Well, there's a few that I really want you guys to focus on. And the first one is your, and these are all as a percentage of annual revenue. So the first one is your cash and cash equivalents. This one right here. Basically, I want you to have a minimum in the bank at all times of 10% of your annual revenue. So I'm going to take an annual 12-month revenue. If you're a growing company, look forward, look in the future, your 12-month future revenue. If you're a flat company, you're not growing, you're just kind of hanging in there, staying in there, not in which is perfectly fine. Then you look at a 12-month running. So it really depends on which type of where you're at in the growth stage there. But we want to at least have 10% of your revenue. So let's see what this company, for example, has that money in the bank. So again, how do we calculate it? We look at, first of all, the revenue, $4 million. Take that $4 million times 10%, which equals $400,000. That's what we want to have in the bank. We go back here and look at our balance sheet again, and in this case, you can kind of see between operating cash and cash reserve, they have $448,000. You know, high five, they're doing great. So that's, again, one indicating that we think, and this is going to really depend on the company's health. This is going to really help you on the health. The reason why you want that much money in the bank is a lot of different reasons. First of all, you don't have to worry about timing issues. You know, if payroll comes out before you get that, you know, that big deposit, or, you know, you don't have to worry about that kind of stuff, because cash solves a lot of problems for a company. It makes small problems go away. Whereas if you don't have cash, small problems can become huge problems, and we want to avoid that. Plus, cash gives us the opportunity to make mistakes, which is nice too. You know, so, you know, it'd be great to run a company and never make a mistake. You know, again, nobody on this meeting, I'm sure, has ever had that issue. And so what cash allows us to do is it allows us to give that opportunity or protection. And so that's why it's so important to have a running 10%. Now, what if you generate more money? How much they keep in the bank? Well, that's your call, but I want you to keep at least 10%. Now, if you see the drawing here, it's 10% to 30%. What does 10% equate to? About 2 months worth of expenses. 30% is about 6 months. 6 months would be ideal, and they would be ideal in cases such as if you have a partner buyout that's coming, you know, soon, where you need to actually put a big down payment on a partner buyout, or if you're looking to purchase something, or if you want to invest money into a product. There's a lot of different reasons why you might want 30%, but again, 10 to 30. Another thing would be is, let's say that your accounts receivable, which we find a normal accounts receivable aging is about 45 days. Let's say your accounts receivable is 60, 65, 70 days. You probably want a bigger, you know, amount of money in the bank. So you want it closer to that 30% realm. So again, between 10 to 30%. So now let's look and see about the tax reserve. Tax reserve, again, we want about 6% of revenue, and that equates to about 40% of your net income. And with that, we want that in there at all times. So let's take a look and see if this company has that. Again, we take $4 million times 60%, or 6%, I mean. And in this case, we have which equals $240,000. We look over here, and if you look at the tax reserve, no, we don't have it. We have $40,000. That's pretty bad. Well, not really, because if you think about it, we're making our estimated payments throughout the year. So really, as you can kind of see down here in the distribution side, we made a $60,000 payment in April. If you look over here, we made another $90,000 payment in June. 60 plus 90 equals the 150. Another $74,000 in September, and so forth. So we had a $224,000 total payments. So if you look at 40 plus the 224 equals 264. So boom, we've got it. We're satisfied there. We've got enough money to pay Uncle Sam, and actually we paid the majority of it to Uncle Sam already. But as you can see, that money is set aside there. The owner, knowing that they're going in April with that money in the bank already reserved, earmarked for the taxes, is a complete relief and not a surprise at all. So again, really important to have that tax reserve built up. Next one's the accounts receivable. You want about 8.3% is a 45-day turn on your accounts receivable. 16.7% is, again, a 60-day. So again, you want to make sure it doesn't get any further than 6.7. If you do, you need more money in the bank. 8.3 is relatively where you want. So in looking at that, you're going to look at your accounts receivable line at the 150 there. Do the math again. 150 divided by $4 million equals 3.75%. So in this case, the lower the better. Boom, 3.75% looks great. So no issues there. This company is looking pretty healthy. The last ratio that we look at is kind of the combination of all the ratios there, the cash, the total cash that we have, the total receivables, include your tax reserve, everything. And we take that and divide that by the current liabilities, again, your line of credit and so forth. This is called the quick ratio. Don't get too mixed up about what the name is there. But you're looking, again, current assets minus junk, which we don't take into consideration any of the funky stuff like loans between shareholders and stuff like that. And we want to come up with, I would say, between a 5-to-1 ratio to a 6-to-1 ratio, somewhere in there. The higher the better with this ratio. So I'd love to have a ton of cash and no debt. That's obviously the goal here. And so with that, let's look at this company. This company, we're looking at $638,000 for the current and $40,000 for the current liabilities. So we do the math again, it comes out to 16-to-1. So again, this company is extremely high, extremely outstanding. We're finding that companies in the industry are going to be closer to 5. This would be a great goal to have. Again, not really realistic at this point for a lot of you folks, but for the most part, this is where you'd want to be. A 16-to-1 ratio is way above this. Again, the higher the better on the liquidity ratio. So those are the 4 different areas that we really like to focus on. The chart of accounts, building up a chart of accounts where you can really understand where you're going with it. Cash versus accrual. If you're not on an accrual basis, convert yourself to accrual basis. Make sure you know what you're doing when you do that so you don't screw things up for taxes. Financial statement metrics, again, the different metrics we talked about would be the income statement and the balance sheet. And then really how much money we need in the bank, again, that's the golden rule is 10%. 10% minimum every day of the week, and that's excluding the amount that you set aside for Uncle Sam, your biggest partner. So that wraps up my presentation. Now, kind of going through some of the questions that we had. Let's see, John asked, would you release tax reserves if your profitability fell dramatically inside a year? Oh, that's a great question. With the tax reserves, the way we set that up is that we set that up so that when you file your tax return at the end of the year, your accountant's going to get your quarterly estimated payments. So that's the amount that we're going to make, that's the amount that we're actually going to pay on those quarters. So if, and again, you go the greater of or the lesser of how much you actually are making during that year versus what you made the prior year. So I'm going to say in first quarter, everything's going great. First quarter was awesome. We're going to pay our quarterly payment. Second quarter was awesome again. It was actually way beyond awesome, way beyond last year. I'm still going to make that minimum quarterly payment. I'm not going to make 40% of what we actually made. I'm going to make that minimum. I'm going to keep that money in the bank. The third quarter, horrible. Fell down. We lost all profits and everything from that third quarter. We're now way below. So in that case, John, in that case, I would not make my quarterly payment in the third quarter or make a smaller quarterly payment to adjust for that money because cash is king. Don't give Uncle Sam the money now if you're going to get it back, to get it back in 9 months from now. You need to use that money to make sure that you're actually generating, keeping cash in the bank. So actually, super question. Let's see, Emily asked, production expense or production education would mean you need a separate let's see, oh yeah, okay, yeah. So what she's asking is, do we need a separate education account for both your producers and your administrative team? Absolutely. As mentioned, their production education is going to be your production team because that's going to be how much it costs for your producers. Again, an integral part of how we look at your financial statements. And then the administrative team will have its own education, marketing will have its own education, again, so that we can see if things aren't going as well as they need to be, where are we fat in? Are we fat in the administrative area? Are our producers not making enough, earning enough, and so forth. So it's really important to break them out in all 3 different areas. Elizabeth asked, if an employee that is both admin and producer, where would you record their payroll? Good question. I would record their payroll, first of all, in producer. And then at the end of the month, when you're going through your timesheets and everything, if you want to make it simple and say, you know what, generally that person's a 50% admin, 50% producer, I would split it, just do a journal entry and split it between admin and producer. You know, make the default producer in case you ever forget, so it doesn't screw that number up, but then push a little bit of it down to admin. And that's a real similar question to like the owner. Like we mentioned before, the owner is going to be split between possibly 3 different areas. More than likely just 2 between admin and marketing, but could potentially be split within 3. So at that point, I would do a journal entry and basing either on actual time they actually did work or estimated time, you know, based over, what you feel is going to happen or has happened in the past. Let's see, Dan asked, where would you record sales commission? Sales commission would be no different than marketing salary, and that would be reported in the salary. If sales commission is given to an outside contractor, then that would be as a contractor expense in the marketing side, which I did forget to mention that if you have contractors in the production side, that's also a line item up there in the production cost. So production contractors stay in the production, and then marketing, admin contractors would be down in the admin or marketing, depending upon where they're at. Chris asks, how would you recommend charting owner's comp when there are multiple owners that are part of the marketing and production? You know, again, I think I mentioned that again. Owners get split up, you know, based on where they fall or what their actual purpose is, whether it's marketing and production. You know, a lot of times you might get one owner that's 100% biz dev, so they go to the marketing, one that's the president and becoming there, or going to be in the admin side. Jason asked, during the balance sheet, if you have 2 owners, would you factor 2 times 150? Absolutely. Basically, what you want to do is you want to do the 150 per owner, and that could potentially tell you that you are not making enough money in your company to support 5 owners or 6 owners or 7 owners. So yes, 150 per owner. And the reason why I say 150 is because there's a lot of risk when you own a company. Ton of risk that your team will never, ever, ever understand. And with that, you really need to make at least the 150 in order to really, in my opinion, you know, be an owner. Otherwise, just go find a job somewhere. And I sincerely mean that. 150 is where you're at, but we don't want to get carried away either. We don't want you putting 400,000 in there and really screwing things up. So we always want to actually, you know, roll that down to 150 per owner. Chris asks, how do you balance having a healthy amount of cash yet avoid having major taxes on that cash in the year? Okay, keep in mind you're only paying taxes on the money you earned that year. So as you accumulate that first year, yeah, if you don't have any money in the bank, you're gonna pay taxes. There's no doubt about that. The second year, it's only really the difference, because it's not the money that you've earned money on. It's only that year, because you only pay taxes on your net income for the year. So don't think that at the end of the year you got to spend all that money so you don't pay taxes. That is a horrible decision. I would never spend $1 to save 40 cents ever. If you do, come to me. You can pay me $1 to save 40 cents. And you know, with that, you know, just think about that. When you kind of think about that, it doesn't make any sense at all. So yeah, so Chris, in that case, I would definitely pay the piper at least 1 year. You're going to have to. There's no other way around it, because you earn the money. But again, as you accumulate money and maintain that money, you're going to do it. The biggest KPI you can have, you know, is actually how much you pay in taxes. You know, because you know that's the high thing. Obviously, you don't want to pay too much. You don't want to pay more than your fair share. But if everything's equal there, the amount of money you pay in taxes is one of the biggest KPIs, because you really can't avoid it. Jen asked, do you see common percentage of overall costs usually spent on producers versus admin? Well, if I'm looking at producers in general, 50% of my cost is going to producers. 30% of my cost is going to admin. I would say out of the admin costs, I would say probably, if I'm just trying to think through it, about 10% of those admin costs, so probably 10% to roughly 50% of the producer cost. Not sure if that answers the question or not, but again, if you look at it, the whole thing, it really depends upon whether or not you're falling in those categories. Again, if when you look at your revenue and your admin people are in the admin side, and your overall admin expense is 40%, well, that's way too much. You know that you don't have enough producers up there producing in order to sustain that. So that's where you kind of look back into the presentation and you compare, you know, where the numbers are at, where they fall within your production cycle there. So again, looking at that, 50% producers, 30% between your admin and marketing team, and then 4.5% for your facility costs. Erica asks, what is your recommendation for recognizing revenue for large projects which takes place over several months? That's a very common thing. The way that we do that is really simple. You look at the time that you incurred within that time frame, and you recognize revenue on an ongoing basis. So for instance, if my job took 6 months, month one, I look at my timesheet and I say, hey, here's my timesheet. Here's how much time I've got in that job, which is 300 hours. My average billable rate's 150 or whatever that might be. Take that. That's what you're recognizing in the month of January. You do the same thing for February. How much time do I have in February times your average billable rate? March, April, May, June. And then when you get to the end of the thing, July is kind of like your makeup. If you don't have if you've got all this extra time and you can't bill for it, or that's when you have what we call a write up or write down in time. So you recognize revenue along the time that you actually worked, no matter when you invoice the client. Let's say you invoice the client 50% of it in January. I take all but 1 month of that and slide it to the balance sheet, and I pull it from the balance sheet on a monthly basis, so that through unearned revenue, so that I could actually recognize it in the period that I have. Again, we're looking at an accrual basis, not a cash basis, when it comes to recognizing your revenue. All great questions, and again, I appreciate you taking the time to listen to me today. If you have any questions, feel free to follow up after the interview or after the meeting.
All right, thank you so much, Jody. Really appreciate you being here for our second webinar. Thanks to everybody who tuned in. Hope you learned a lot. And if you do have any follow-up questions, feel free to hit us up in Slack or via email. And we will be in touch soon to let you know what the third Bureau webinar is going to be. And until then, everybody have a great weekend. We'll talk to you later. Bye, everybody.